Here we are talking about the Great Recession. So we've gone from a lot of US economic history to something that's more relevant and more recent today. So when we talk about the Great Recession, what we're talking about is this dip that happened in the economy around 2007, 2008. So this blue line is the actual real GDP controlling for inflation. And that red dotted line is what the projected growth would be. So you see at the early 2000s, you see that the GDP was lower than the expected growth, and that's what we call the dot-com bust, the recession that happened that time period. We're not going to talk about that in this class, but this one we're going to talk about is this very large drop starting in around 2007, 2008. That's what we talk about the Great Recession. So we talk about the Great Recession, it had a huge impact on jobs. So the number of jobs decreased dramatically at this time period. Those that were unemployed, so those are people looking for jobs but can't find them, increases dramatically from close to 7.5% to almost 17.5%. That means almost 1 in every 5 Americans who were looking for a job couldn't find one. It wasn't just losing jobs for a little bit, but these were people who lost jobs for 27 weeks and over. So there are people who are looking for jobs for 6 months and can't find them. These number of people is increasing dramatically. So that's 7 million people at the height of this recession were looking for jobs but couldn't find one. So what talked about it? Or what caused the crash? So there's many factors. We're going to focus on the housing market and the result that had on financial markets, banking failures, the money supply and government regulations. But we're going to focus primarily on the housing market as the major cause. And so how could the housing bubble burst bring down the entire market at this time period? So when we do this, let's first talk about what a home loan is. So a home loan is when a bank gives you money to buy a home. So they give you money up front, and what you promise in return is to make monthly payments back to the bank. Now, the reason why the bank is going to do this is because they'll give you $300,000 today, and over the life of the loan, you will pay them $450,000. So that's why the bank is making this loan. Think of this not necessarily as a home loan, but think of this as an investment from the bank. The bank is investing $300,000 to get an interest rate return on that. That over the life of this loan will give them $450,000. So there are different potential ways to get a home loan. The traditional home loan, it means that you put 20% down. The home loan, the length could range from 15 to 30 years, and there's a fixed interest rate. And so that's traditionally how it's been done in the United States. The FHA, the Federal Housing Administration, started back in the earlier 20th century to create FHA loans. And so these are loans that are insured by the federal government. And so they require only 3.5% down. They can also go from 15 to 30 years. They also have a fixed interest rate, but they require the individual to purchase mortgage insurance, such as if they default on the loan, the federal government would then use that mortgage insurance to pay off the bank for that loan. The third kind is a subprime home loan. So these are 0% down. They go for typically 30 years, and they have an adjustable interest rate. So to give an example of each of these three, so let's consider a $300,000 home. So for a $300,000 home with a traditional home loan, you would pay $60,000 of down payment. You would take out a loan for 30 years. If the interest rates are 4%, the monthly mortgage payment would be about $1,146. Now, if you did an FHA loan, you only have to put down $10,500. So this is one reason why people go for that FHA loan, is because it's easier to get into the home for the first time. It's also a 30-year interest rate and at a 4% interest, or 30-year mortgage at 40% interest rate, and a mortgage insurance of 0.75%, your monthly payments would be about $1,500. So now notice that it's a much higher monthly payment because you've put less money down and you're also having to pay for that mortgage insurance. So typically people would take out an FHA loan until they can build up enough equity, meaning they own enough of their home to refinance and to use the equity of their home to do a traditional home loan. Now the third kind of loan is a subprime home loan. So this is 0% down, 30%, 30-year loan, but the adjustable interest rate means it's going to start at 5%, and then after 2 years it's going to increase to 12%. So that means for the first 2 years, you make a payment of $1,600. But in that second year, we have a balloon payment, which means your monthly mortgage will go up to $3,000. Now, the reason why individuals would take this out is they'd hope that the home prices would increase, or they'd be able to save up enough money to be able to refinance within the first 2 years before that adjustable rate interest comes into effect. And so when we think about this, so those are the three types of loans. And what the bank is really doing is they're buying an investment. So if we think about a home loan, the bank might loan you $300,000 at a 4% interest. And so what this means that for the next 30 years, the bank is going to receive $1,400 in payments. So the bank can then say, well, we don't want to keep that. After a year, we might want to sell that. So after a year, there's a little bit less of money being owed. And so they give it to a rating agency. And the rating agency looks to see the history of the individual, the credit rating, the home, the equity, and they give this a rating. So let's suppose the rating agency gives us a single A rating. A triple A is the highest and a B is the lowest. So this is a fairly good rating. And it may be that after a year, this gets a rating of an A, whereas at the start, they may have given this a rating of a B. But because the individual made every payment for the entire year, they might then now give this a A rating. So the bank might then sell that loan for $290,000, which is slightly more than what's owed. And so this is what we call a mortgage-backed security, where we're actually trading these home loans and buying and selling them on the open market. And what really happened in this time period is we created what we call collateralized debt obligations. So we take 4 home loans and we add them all together and then sell off those 4 home loans in a CDO. So a CDO just means that we're getting monthly payments from a debt obligation, like a home loan. The challenge with this, though, is each of these home loans is going to have a different rating. And so it might be that these independent rating agencies like S&P, Moody's, and others rated each of these loans as different ratings. So that third home loan is the highest rated, meaning that they're almost guaranteed to make these payments. That second home loan is actually very risky. It has the lowest rating. But they would go through then and give these ratings, for each of these home loans, but when you put it into a CDO, that CDO would be evaluated and rated. And what we've oftentimes found is that rating agencies rated these CDOs as a AAA rating, even though it contained many different home loans that were not AAA. And so because of this, it gave banks an incentive to try to give out a lot of different loans and then create these CDOs and sell them off to other banks, to investment banks. So Zions Bank might give out these loans here in Cedar City. They might package those and then sell them off to an investment bank. So who are these investment banks? Well, these are banks that are using money from retirement accounts to invest. And these might be very good investments. They're purchasing money up front so they can have a steady stream of payment in the future. So what happened? What happened is that home prices stopped increasing as quickly. And what it really meant is those that did subprime mortgages, that they could not refinance their homes. The hope was, and what the practice was for many years, was to take out a subprime mortgage. The home would double in value in a year. They would then refinance the home, and they'd have 50% equity in it. And so as these balloon payments hit, because they couldn't refinance their home, they stopped making payments. This meant that those investment firms that had purchased these CDOs stopped getting money. As a result, they still had obligations to pay bills, specifically the fund retirement accounts. That they had to make monthly payments to retirement accounts to individuals whose money they were investing for retirement. And so this created the major collapse, that it was now that these investment banks were starting to go bankrupt. And so why did this happen? Well, it really was this issue of regulations failed. These rating agencies were not rating these very accurately. And so it really created incentives for banks to give out these loans, package them in CDOs, and then sell them off. Some people saw it coming. Michael Lewis wrote a book called The Big Short that addresses this. There's also a movie with Steve Carell and others, Ryan Gosling and Brad Pitt, that address the same thing. And so this is what really happened, and this is what led to the individuals losing their homes and these investment banks from having money and still having to pay their obligations. So how bad was it? $5 trillion in pension money was lost. Real estate value, 401k savings, bonds, it all disappeared. 8 million people lost their jobs. 6 million people lost their homes. Many financial institutions were on the brink of failure. Many of these firms were called too big to fail, that they were just too big of financial institutions like Bank of America, that if they failed, it would be catastrophic for the economy. So what are the possible solutions? Well, you have here the Austrian view of economics, which is the free markets. Let these banks fail. Those banks that survive through this are going to be better off as a result. Or the second is the Keynesian approach, which is government intervention. At this time period, the Great Depression was the model. And so government adopted this Keynesian view of economics to get involved to try to reduce the effects of the Great Recession. So quoting from the Troubled Asset Relief Program, to help stabilize the U.S. financial system, restart economic growth, and prevent avoidable foreclosures. Again, this might be reminiscent of the 3 R's from the Great Depression: relief, reform. Oh shoot, what's the third R? Um, I probably should know the third R. We'll come back to that in just a second. Brain slip. So the federal government would use $700 billion to buy troubled assets from the bank. By buying these troubled assets, it really allows the banks to be able to pay the obligations they had. So $250 billion to stabilize banks and so on and so forth. Well, very large amounts of government spending. But it was very similar to the New Deal. Again, we saw those 3 R's in the New Deal, which I can't remember right now, but we see that similar thing happening with this, is that they're trying to restart and help strengthen the government. And so when we look to see what else happened, is they focused a lot on the Keynesian economics. That is, they focused on trying to have government spending increase and focused on increasing consumption. And so the American Recovery and Reinvestment Act of 2009 was attempted to increase consumption and government spending. And that was the focus, and the similar focus that we saw during the Great Depression. Other examples, we saw $8,000 home buyer credit, expanded EITC, all these programs designed to try to give people money to try to increase consumption. We also saw the expansion of monetary policy. The Federal Reserve stimulated the economy by doing expansionary monetary policy. They bought bonds. They reduced the federal fund rates, trying to do things to stabilize and improve the economy. So the question is, did it work? Well, here's just a graphic that shows what happened to AIG. So AIG, I think, received $182 billion. No, AIG did not receive that much. AIG only received $22.7 billion. That's how much the government gave. And as a result, AIG was able to recover rather quickly, and this was in a form of a loan. So they paid back that loan. They increased the number of jobs, and it was a very beneficial thing that happened with AIG. The auto industry, which saw huge major bailouts, saw that their number of jobs increased dramatically. There are several studies that focus on what were the effects. So in the question of did government response work? Well, it's clear a lot of the research focused that it did create jobs. For every $100,000 spent, it created about 3.5 jobs. In year one study found that it created 2 million jobs. That same study found that by March 2011, it had created 3.2 million new jobs. Another study looked at how many jobs did it save. So those were new jobs that it created, but by stimulating the economy and saving this, it also prevented people from losing their jobs, and estimated that it saved 2.7 to 3.7 million jobs. Another study found that it actually increased GDP. That GDP increased, meaning the amount of size of the economy, as a result of this. But other studies find conflicting evidence. One study found that it created more government jobs at the expense of private jobs. So a lot of these jobs were government jobs. And this one study said that that was not necessarily a good thing because it came at not creating enough private sector jobs. Another study found that it did not lead to significant increases in consumption, that it just wasn't effective in trying to increase consumer consumption. And so there's a bit of different responses. But when we think about this, what we really want to think is, did it work? Well, what lessons are we learning today? Because the COVID recession, which we'll talk about next time, spans both a Republican president and now a Democratic president. And what we're going to see is what we learned from the Great Recession, based on what we learned from the Great Depression, are the exact same policies that we're following right now for the COVID epidemic.